Now let's talk about another problem that arises in insurance markets, and that's what's called moral hazard. So once you have insurance, you don't suffer all the losses if something bad happens to you. So once you have insurance, your incentive to avoid risk is lower. Okay. Again, because you've got someone else who will cover some of your losses if something bad happens. So therefore, you're going to go ahead and be less careful, typically, we think, than someone who has to absorb the full consequences of their potentially risky behaviors. So moral hazard is something that happens after you have insurance, and it's common for students to get moral hazard and adverse selection confused. Adverse selection refers to the fact that some people are just inherently riskier than others. They have an above average demand to buy insurance. Moral hazard is once you have insurance, that changes the incentives for your behavior. So, why is this a problem? Well, this is another reason that when we give people insurance, the level of risk and the payouts that the insurance company actually experiences are likely to be higher than you otherwise might think, because now that they have the insurance, they file more claims because they have more losses than they otherwise would. So how do insurance companies deal with this? Well, there are things like copayments. So when you have to go ahead and pay $20 because you're going to the doctor, that gives you a little bit of an incentive to take into account the cost that you're imposing on the system as a whole. Or we might think about things like deductibles. Deductibles mean that you're going to, again, share costs with the insurer, because the first, say, $500 of damage to your car in an accident you have to pay for. So that encourages you to have, as they say, some skin in the game. So skin in this game is the idea that you have something to lose if things don't turn out so well. So moral hazard is a second problem out there. And this comes up in lots of contexts out there. So for instance, a loan has an element of insurance in it, because essentially you may have some ability to walk away if housing prices decrease. The fact that you have a down payment functions like a deductible or a copayment. It makes sure that you have something at stake in the transaction, so that you have some incentive to go ahead and keep track of the amount of risk that's engaged in the transaction. Or we'll see later, when we think about the banking system, we think about equity capital. How much of the bank's own money is going out in the loan as compared to the depositor's money? And the more of the bank's own money that is being lent out along with the depositor's money, the more careful the bank typically is going to be, and it's going to go ahead and watch the quality of its loans and be a little bit more diligent about making sure that those loans really are relatively safe. Or if we were thinking about social insurance, once you have unemployment insurance, that may alter your incentives to look really hard for work. But we could go ahead and say something like, well, we're going to go ahead and gradually taper off your unemployment insurance so that, it starts off at a relatively generous level and it gets less and less generous as it goes on. Or we could say, well, yes, we're going to give you unemployment insurance, but we're going to make you show up at a given place and time and, pick up trash by the side of the highway or something like that, to go ahead and give you some incentive to go out there and look for that job that you otherwise might not have. So a lot of things that happen out there in both private insurance and in investment and in public insurance, social insurance, have to do with trying to control these issues of moral hazard. So this is something to preserve the incentive for people to go ahead and take account of the fact that their behavior affects other people.